Hello everyone, and welcome back to the Velocity channel, where this is your bridge to financial freedom. Today, I want to go ahead and make sure that you understand that there is a difference between debt snowball, debt avalanche, and debt blizzard. Now, the last one you probably have never heard of, but we're going to go ahead and hop into that, as well as give you some real life examples. Yes, we're going to help another person out with real numbers right here on Velocity channel. But before we get into that, I want you to like, share, subscribe so that everybody around the world can know the power of Velocity Banking. Are you ready to get into this? So am I. So there's been a lot of controversy on which method is better, debt snowball versus debt avalanche. Listen, the truth of the matter is that each have their own efficiency and effective level. However, when you team it up with this banking strategy, this Velocity banking strategy, you tend to do way better. So Velocity banking does not have any competition, all right? Right? Just like hydrogen atoms don't have any competition with oxygen, you need both to make water, okay? And you need both in order to have an effective and efficient strategy that is premium to your situation. Now, debt snowball plus Velocity banking equals debt blizzard, all right? And if you're going to use the debt avalanche method and team it up with Velocity banking plus Velocity banking, you're also going to have a debt blizzard. Now, what is a debt blizzard? A debt blizzard takes these concepts and turns it into where it makes your debt disappear very quickly. And those of you maybe in Colorado, Alaska, Iceland, all of these wintry places, you know what I'm talking about when I say disappear. I mean, 1 minute you're in the snow and then the next minute you can't see anything. And that's what happens when you place debt snowball and Velocity banking together, or debt avalanche and Velocity banking together. You're not going to see your debts anymore very, very quickly. And I'm talking about mortgages. We're talking about auto loans, any loan. Whenever you team it up with this, you can consider it gone very soon. As a matter of fact, I'm going to show you how. All right, so like we always do, we want to make sure that we get an overview so that you have the correct knowledge that you need to implement this within your scenario. Whether it's auto loans, mortgage, or you just want to pay all of them off very quickly, we're going to show you how right now. Before we get into that debt snowball, okay, we need to know what that means. So with the debt snowball method, you're going to be focusing on the lowest debt, right? So this, out of the 20,000, 25,000, and 30,000, this is the lowest debt, and that's what you get with the debt snowball. That's your choice, because this is more of a psychological method. If you can knock out these lower interest rates, right, or excuse me, these lower balances first, then it'll give you more momentum to knock out the next highest ones. Now, with the debt avalanche, it's going to focus on the higher interest rate loans so that you can get out of those loans and then place that cash flow onto another debt if you need to. So it doesn't matter what the balance is, we've got to get rid of those high interest loans. That's going to be the priority when you're talking about the debt avalanche method. None of them are bad, they're just missing something. And we're going to show you what they're missing right now with the real scenario. So, and folks, this is a scenario in which, sometimes you get these, all right? Sometimes you get these. Sometimes you get where you have to do the debt avalanche and the debt snowball. What do I mean? Well, sometimes it's a high interest rate, and this is a real interest rate, folks, and it's the lowest balance, okay? And sometimes it's like that. But when you're doing Velocity banking, what did I say to pay attention to the interest rate? Watch it drop dramatically, because what the dealership or what the lender is telling you about this interest rate is not true for you as long as you're implementing the Velocity banking method. Whether you're doing it with the debt avalanche or the debt snowball. Remember, when you combine these, it then becomes a debt blizzard. And this is what I mean. Let's say you've got the $16,000 at 18%, okay? That is a horrible cash flow index of 39, okay? Most likely you're gonna need to get rid of this loan, this cash flow sucking loan, as much or as quickly as possible. $406 each month for what you're getting, $16,000, we got to get rid of that. So this is how we do it. Yes, if you had a balance on your line of credit of $8,000 at 21%, perhaps this minimum monthly payment would be slowing you down. Remember, if you are segregating your income, it only slows you down. That's why we need to utilize our line of credit as our new checking account with wisdom. That's why I say contact me. That's why I say we got classes. That's why I would say we have worksheets to make sure that you're in the best possible position to do this. And once you do, guess what? You don't have to worry about this $180 minimum monthly payment. That actually goes right into your cash flow. Now, this person's cash flow is $1,000 each month. They have a balance, let's say, of $8,000, okay? How long is it going to take them to get out of this line of credit balance? Remember, we cross out the zeros. Okay, and now we have 8 months. Why? Because we're going to divide the line balance, the line of credit balance, by the cash flow. That's going to give us our velocity term, which is 8 months. Now that we are out, up from under that $8,000, what can we do with it? That's right. We can go ahead and apply it to the principal. Now, what happens to the principal when you apply $8,000 to it? Let me show you. Folks, if you don't get anything else, I want you to get this. That as soon as you release your line of credit, you make that transaction of $8,000 or whatever it is, you jump ahead months, even years, because 36 months is 3 years. You jump 3 years in advance. So it's kind of like a time collapse transaction, all right? That's what you're doing. So all of a sudden you are at this timetable, okay, in your amortization schedule. 36 months, $126 goes to interest, $280, that is more, going to principal, paying this off. And so now that you're at the $8,000 balance, what happens next? Well, you're just going to continue to pay month after month while this replenishes. Now, how long is it going to take to replenish? That's right, 8 months. So you're going to continue to pay 406 times approximately 8 until you replenish your line of credit. And then what happens? Well, you diminish that. And what was going to take you 5 years has now taken you a little over a year, not even a year and a half, about 16 months. Okay? And that's because we had to pay this off. What if we didn't have to pay that off? Right? So you chose correctly, right? In both scenarios. You chose the debt avalanche, and you chose the debt snowball. But the only thing that'll help you pay it off in 16 months instead of what? 3 years, 4 years, 5 years. It was you added the velocity banking, which turned that debt snowball into a debt blizzard, which turned that debt avalanche into a debt blizzard. We have all kinds of tools and education for you. There's no reason why anyone on the planet should be in debt up to their eyeballs, bad debt. So folks, if you have any questions, please don't hesitate to give me a call, enroll in the class, get the material, because it's for you, all right? God bless you, and you take care.